Professor Robert Merton, only a few sentences on his personality. Of course, he is well known everywhere and by everybody who is active in finance, but looking into the biography always puts things in a certain perspective, which I find important. He received his PhD in economics from the MIT in 1970, and very shortly afterwards he wrote his seminal piece on option pricing. He served on the finance faculty of the MIT Sloan School of Management until 1988 when he moved to Harvard. Professor Merton is the past president of the American Finance Association, a member of the National Academy of Sciences, and a fellow of the American Academy of Arts and Sciences. He received the Alfred Nobel Memorial Prize in the Economic Sciences in 1997. So thank you for accepting our invitation, Professor Merton. The floor is yours.
Well, thank you very much. It's a great pleasure to be here on the celebratory occasion honoring Bob Shiller for his important works and contributions both to academia and to the world of practice. For nearly 4 decades, financial innovation has been a central force driving the global financial system towards greater efficiency, with considerable economic benefit having accrued from those changes. The scientific breakthroughs in finance in this period both shaped and were shaped by the extraordinary innovations in finance practice that expanded opportunities for risk-sharing, lowering transaction costs, and reducing information and agency costs. Today, no major financial institution, including the central banks, can function without the computer-based mathematical models of modern financial science and the myriad of derivative contracts and markets used to extract price and risk discovery information, as well as to execute risk transfer transactions. Financial innovation will continue, in my view, to contribute importantly to economic development and growth. But also today, we are still in a global financial crisis of a magnitude and scope not seen in nearly 80 years, which at least some attribute to the changes in the financial system brought about by financial innovation, derivatives, and mathematical models. My remarks this afternoon will mirror these two seemingly contradictory characterizations by applying the very tools of financial science and derivatives to analyze and offer observations on structural effects of the crisis of systemic risk of the financial system and on needed regulatory changes and policy responses, and also to make some suggestions and evidence in the view that financial innovation will continue to contribute to economic growth and benefits. Okay. Forgive me. Whoops. Is that okay? I point it this way? Okay. Yeah, you can see I'm very experienced with PowerPoint. Now, my remarks will touch on 6 issues, actually really 5, because I realize, looking at the clock and how I go, that I won't get through all of these. So the first will be on structure of credit risk propagation, questions such as how can such large risks build up without recognition, then appear to explode, the questions of how could banks during the early parts of the main part of the crisis stop lending, stop adding to their portfolios, and nevertheless report still more losses and larger losses than in the preceding quarter. Second, I'll talk about on the need for an integrated systemic risk policy by showing that a superposition of benign, in fact, favorable economic activities, when all put together, can nevertheless create substantial systemic risk. And I'll draw on the mortgage market for that. Third, on the question of policy, government policies, with respect to systemic risk, in making decisions between takeover versus allowing bankruptcy for financial institutions in distress. And given the short time, I will just allude to that in comparison of LTCM, long-term capital, in 1998, with Lehman in 2008. Then I will turn from these elements of the crisis as looked at through finance science to a brief but I hope telling example of possible innovations that can come from this thing. As you'll see, my last topic is government regulatory reform and policy recommendations going forward. I do indeed have those slides here, but I do also suspect that given this agenda that we won't really get to them. So it's a kind of teaser to tell you they are there, but you will probably not get to see them. Okay? Skip that. Okay. So let's go to the first one. And at the heart of this crisis has been credit, banks, and guarantees, using finance to understand and explain how these risks can grow. I want to go through a basic description of what it means to be a lender, not of any complex instruments like CDO, squares and cubes, and all the things that we talk about, but think of classic vanilla lending, either to a corporation in the form of loans or debt, or to households in the form of mortgages. You'll see on the example here, I use a corporation. You can see its balance sheet. If you prefer households, replace the balance sheet. The assets, instead of being operating assets, you can think of that as a house. And the debt, you can think of as being a mortgage. For the purposes here, it's identical analysis. Now, if I had here a loan or mortgage, and here a guarantee from the appropriate government of that loan or mortgage, you staple them together, functionally what do you have? You have a risk-free asset, just like a government bond. It seems pretty clear. Well, it's not so clear if you look at some of the CDS on the governments. But anyway, all right. So now let's pull the guarantee away. What are we left with? What does it mean when we have a loan? Well, we still have a guarantee of the loan, except instead of it being a third party to the government, it's you. You're guaranteeing it yourself. So what we see from this is functionally, every time you make a simple loan of any sort, you're really in two businesses. You're lending money risk-free. That's the time value of money. We all understand that's a very well-defined concept. But you're also doing something else. You're writing a guarantee of that debt. Guarantees are insurance. So in effect, you're writing insurance on, in this case, this financial instrument, and as we'll see in an instant, actually on financial assets of the borrower. So you're two things, and that's fine. Insurance is one of the great traditional businesses. It's been around for hundreds of years. However, it's very important to know that you're in the insurance business and that you're writing insurance, and indeed that's the first point here. Now, if you observe that, then we can ask ourselves the following question from looking at the balance sheet. One of the things we know is that the left side always equals the sum of the right side. What happens when you have the case of a guarantee? What does that guarantee give you? Well, in the event that the corporation or the household can pay what's promised, the guarantee turns out to be worth nothing. Not unlike insurance you buy on anything else where you don't need it ex post. So that's fine. In that case, if there's no default, if you're paid, the value of that guarantee ends up being zero. But what happens if you don't get paid? There's default. Then the value of the guarantee is the difference between what you'll receive as the promised payment, on the chart here, B, and what you would recover as the creditor if you seize the assets and liquidate them, which is A. So you get B minus A. The difference between what was promised and what you could liquidate for. If you write down that payoff function, as I've done here, I hope at least for many, those in finance for sure, that you recognize what this is a payoff to. It's a payoff to a put option. A put option where what's a put option which guarantees the right to sell something at a specified price, where the strike price is the promised payment on the debt, and the underlying thing that put is on is the assets of the borrower. The house in the case of the household, corporate assets in the case of the corporation. Well, that may be fine. Why do I point this out to you? Because we know an awful lot about put options. It's a very classic option. It's been traded on exchanges for at least 35 years and traded much longer in over-the-counter markets. And we have a great deal of learning curve experience on how to price put options, what affects their prices. There's an enormous amount of modeling, both in the practicing community and, as I said, learning current experience, trading them. So instantly we see functionally that this guarantee that's embedded in every debt is really essentially the equivalent of writing a put option. So we can apply all of that theory and knowledge to do it. Now, for those of you who have heard the many acronyms, one of the ones most used in this crisis have been CDS, credit default swaps. Well, credit default swap, it's a little more complicated, but basically a credit default swap is nothing more than a guarantee of the credit of an issuer. And so we see that a CDS is also functionally like a put option. So we now sort of quickly understand what it is these all are and take some of the mystery out of it. Well, now how do I propose to use this to help us understand